name is Alec Ross, and I am a New York Times bestselling author. I wrote a book called The Industries of the Future, which translated into 24 languages. I'm a former government official who's currently serving as an advisor to one of the Democratic presidential campaigns. I am working on a second book about the impact of geopolitics on business and business on geopolitics. The volatility that we've seen in markets has been unexpected for many. Many might have anticipated, thinking about U.S. public equities, for example, that it would have just gone down. But one of the things that I predicted back in the beginning of March that proved true was that we were going to see a wildly differentiated set of recoveries or non-recoveries. Certain things that looked like a V, which went down and then quickly shot up, which we're already seeing across much of equity pricing. In certain cases, a U-shaped recovery where we will seeing a bit more of a lag and then an upward trend. But then for a substantial part of the market, we're going to see a non-recovery. We're going to see something that looks more like a capital L, where we've seen some movement downward, and perhaps there's been a bit of a dead cat bounce that's come from the overall increase in the market over the last month. But the fundamentals of the business are damaged to the point where it's bleeding out. And some of these will not make it, or to the extent that they will be able to continue, they'll be so-called zombie companies. They will be so laden with debt that they'll be the sort of walking dead. And what's interesting is I think we're going to see an enormous amount of private equity activity coming up, looking at some of these extremely vulnerable or distressed assets. I think we're going to see an increasing number of bankruptcies, like what we recently saw from Hertz, where the financial engineering of the firm meant that it couldn't continue in its current business format. So what I think the key takeaway, both from the last 2 months as well as what we ought to expect, frankly, for the rest of 2020, is enormous volatility. We can't just project movement up, down, or in between. It's going to vary wildly, sector to sector and firm to firm. And being able to really understand the macro trends as well as being able to engage surgically within some of this is going to be increasingly important. Some of this is a little obvious. Commercial retail, for example, is distressed, and there is not a short-term or even intermediate term prospect for it to be less distressed. I do think that we are going to see a lot of medium-sized enterprises that sort of held their own with the larger platform players in 2018, 2019, really taking punches on the chins as the platforms grow stronger. If somebody would have said to you in January of this year that the big internet platforms are going to be substantially stronger in May or June than they are now, nobody would have believed you because of the regulatory headwinds coming from the EU, coming from the Trump administration. But what is now proving to be the case is that certain of these platforms are stronger than ever. And frankly, there is very little that could make them less strong. There are a few of them, like Facebook, where regulators could pick apart pieces of their business model. But most of the others, I think that there's a strong exception to that kind of intervention that could slow their growth. First of all, the life sciences, even post-COVID, I think we are going to see an enormous amount of capital pushed into the life sciences and, frankly, into the commercialization of basic research. This is going to come from the United States government. It is going to come from the Chinese government. I think we're going to see substantial activity in venture capital and private equity. I think we are going to see larger cap funds increasingly push into the life sciences. And I think that while some of this obviously might be looked at in terms of, pharmaceuticals, vaccine medicines, and what have you, longer term, thinking 2, 3, 5 years out, what I really think is that we're going to see substantial capital moving into the commercialization of genomics. The world's last trillion-dollar industry was built out of computer code. The world's next trillion-dollar industry is going to be built out of genetic code. And some of the most interesting approaches to looking at how individuals can become more resilient in the face of something like a COVID pandemic, the solution to this oftentimes is in something related to genomics, something related to genetic repair. And this is not something that can be commercialized in most cases over the next year. Most of what has been done in the field of diagnostics. But what I see and the trends that I'm seeing is that more and more capital is going to be pushed into not just discovery, not just into diagnostics, but into repair, into making our bodies more resilient in the future. And this is going to be a boon to a significant number of firms, particularly in China, the UK, and the US. The US presidential election on the first Tuesday in November will be the most consequential election imaginable for markets. It just will be. Because if Trump is reelected, first of all the guardrails off of his instincts will come down. So certain of the kinds of convictions that he has, he will really throw his shoulder into them in a second term. We can expect an increased level of competition and frankly conflict bilaterally between the United States and China in the area of trade. I think we can also see things growing more difficult between the United States and South Korea. And then Europe in particular. I think I would be shocked if Donald Trump were reelected and if NATO existed in anything approaching its current format by the end of a second Trump term. And I think that he would turn his trade war, his trade instincts that he's really directed for the most part toward China, I think that they'd be moving across the Atlantic. Now, having said that, which is overwhelmingly negative, I do think that a lot of American equities, given that Trump really measures his effectiveness in whether the Dow Jones is going up or down, I think that there would be a short-term stimulus in terms of the Dow if he were reelected, because traders would know that his own personal yardstick for performance is the Dow Jones. Now, by contrast with Biden, I think we would see a slightly more differentiated response in markets. I think that investors looking at the bilateral relationship between China and the United States would be making a mistake if they thought that relationships were suddenly going to grow warm. They won't. The relationship broadly and as it relates to trade will remain competitive, but it won't be as conflict ridden. But by contrast, I think that we can expect a Biden administration to really re-embrace the transatlantic relationship. And I would be shocked if there were any trade problems between Europe and the United States in a Biden administration. By contrast, in the same way in which some of the traders on Wall Street might see a Trump administration as a boon to them because what he really cares about is Wall Street and the Dow, I think that we would see a more mixed response to a Biden administration. I think that it would bode well for certain aspects. But when I think about financial services and certain other dimensions of the market, I think that the response to a Biden administration would be quite cooler. What's interesting is this book, The Industries of the Future, that I wrote, I wouldn't change a comma in the book. And what's actually happened with COVID is a lot of the trends that were described, both the good and the bad, the promise and the peril, we've seen accelerated. So thinking about artificial intelligence, machine learning, and robotics, when I speak to CEOs, they are looking at their R&D budgets for automation and things that they projected doing over the course of 3 or 4 years, they are now doing over the course of 1 year. The investment in artificial intelligence is massive. One thing that I do think is going to be very hard for workers coming out of COVID-19 is a trend that was going to be, 5 to 10 years in the making of increased levels of automation in the workforce, taking labor that isn't just manual and routine, but increasingly cognitive and non routine from being turned into software. What would have taken 5 years is now going to take two. What would have taken 10 years is now going to take 3 to 4. And that's a function of the massive reprioritization of both R&D and frankly, capital expenditures being made by the FTSE 100, by the Fortune 500, by large firms that say, in the midst of this, we really need to take the next steps in terms of automation.